carnage continues. Stock markets keep sinking, and a seeming reprieve on the tariffs is not helping them to find their footing. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. We get a little bit of a reprieve. The administration in Washington, D.C., saying that goods included in the USMCA, the free trade agreement between the U.S. and Canada and Mexico, will be exempt, at least for a month, from these new tariffs they announced this week. That's after they first exempted the auto industry. But the markets don't particularly like that news and continue to end the day on the back foot. Of course, as we look ahead, the situation doesn't get any less spicy because macro event risk is back with a vengeance here at the end of the week. We've been, of course, watching mostly headlines from the political side of things influencing the situation this week, and the macro data has largely fallen to the wayside. But we get some really weighty bits of news to cap us off. What we're going to do here is we're going to look at what's expected. We're going to see how that is contextualized with what is happening in the markets, and then try to make sense of what it may do next. So, needless to say, the very first thing to address here, the jobs report. The expectation here that the economy is going to add 160,000 jobs. That's just about in the middle of the range for what we've seen recently. Doesn't really amount to a meaningful deviation one way or another. The unemployment rate seen holding unchanged at 4%. That's about a half-year low, give or take. But nevertheless, we have a situation now where taking such expectations at face value is fraught with danger, because as we look at the way that U.S. economic data has performed relative to forecasts, we see increasingly acute deterioration. We can see from mid-November, U.S. economic data has increasingly disappointed relative to forecasts. And now that this Citigroup index has slipped below the zero line once again, recall this was something we saw last time in May when the markets were rabidly screaming for rate cuts from the Fed. And the Fed ultimately delivered them their dovish dreams in September, only to come back to an economy that was already improving. Of course, the markets then thought, well, that's too dovish. We're back there again, and the upshot here being below zero is that the path of U.S. economic data outcomes relative to forecasts now favors disappointment, is trending toward disappointment. To put this in other terms and make it a little bit simpler perhaps to digest, the market is very clearly being met with economic data that is softer than benchmark expectations. So economists' models are, first, set up rosier than reality is endorsing, and two, are not adequately adjusting to the new reality yet. In other words, as data continues to disappoint and as the quotient by which it's disappointing is growing, it's becoming increasingly clear that the economy is on the move, but analysts' models are not being tuned to capture it yet, which of course sets up a situation where the jobs data has a path of least resistance toward missing expectations. Now, that would come at a most inconvenient time for markets because, of course, they have been gripped by recession fears ever since we got the February set of S&P Global PMI numbers back on February the 21st. Now, those numbers have been revised a little bit since, and we'll notice here that we're not quite at standstill for the composite index. The prior forecast was just a hair above 50. The revision that we got this week, as we always do, for these numbers, about a week and a half after they're initially released, gave us slightly faster growth. The service sector, which initially looked like it had contracted for the first time in 25 months, looks like it did grow a little bit after all. But the upshot from these numbers and the recession risk contained therein, that has not changed. This is still the weakest economic growth that the U.S. has seen since December of 2023. It is still the weakest service sector growth that the U.S. has seen since that same period, November 2023. So we're looking at a situation then where the degree of drop off is perhaps not quite as bad as initially thought, but the direction of travel is unmistakable. And it is most worryingly the service sector, which has been the overwhelming driver of demand, that is doing the unraveling. It's tempting, of course, to say that, oh, well, the issue here is tariffs, and once the tariffs represent a one-time adjustment in the price, whatever the final version of these tariffs is going to look like, then we will have a settling of the situation. And indeed, as we can see from looking at the red line here, manufacturing seems to have picked up, but of course, seems to have picked up for the wrong reasons. Now, when we look at what is actually being interpreted here by S&P, we find that the problem in the service sector is uncertainty. It is, in fact, that we don't know what policy is going to look like, and that it seems to be changing as quickly as it is. Businesses are retrenching. Sentiment is down because they don't know what to make of what lies ahead, don't have the certainty to make spending and investment plans. Whereas the pickup in manufacturing is being seen as a front-running of the tariffs. That is to say, companies are trying to buy everything they can before the places from which they source are tariffed. So once that sort of a process runs its course, we, of course, end up with only a temporary boost that unravels. So the lay of the land, not especially encouraging, and lest we get confused and think this is just one data point, here is an aggregator. This is the Atlanta Fed's GDP Now tracker, and while it's probably not a good idea to get stuck on aggregate levels, we can see here that the economy is on track to shrink between 2 and 3% annualized in the first quarter. That's probably aggressive. But the direction of travel is unmistakable. This is a nowcast, which means that it takes in all the incoming economic data and then scales through its GDP model what those outcomes mean. That the green line you see here is falling off a cliff, to use a technical term, tells you that the tone of the incoming data has been overwhelmingly negative, which is why the model is reacting the way that it's reacting. So it isn't surprising then that the markets are concerned about global recession. Why global and not just a U.S. recession? Well, to quickly remind ourselves, the U.S. is the largest component of global GDP, and the overall pie is really only driven by three major engines: the U.S., the Eurozone, and China, making up 58% of global demand. The remaining 42% is mainly made up of vendor economies that serve demand in the growth engines and need to be exporting there in order to generate positive GDP contributions to the global pie of their own. So, of course, when we think about the U.S., we think about Mexico and Canada. Think Central Europe or Nordic Europe with the Eurozone. Think commodity producers from Latin America to Africa to Australia for China. And so you're looking at a situation then where over the course really of the past half year plus, so from about the middle of last year, the US was the only game in town in the realm of growth. China was slowing and has now seemingly stuck into a kind of uneasy sort of sideways drift. Europe was slowing and is now barely growing at all. It's essentially at standstill. Of course, we, as a consequence of all the news flow this week, now have vast expectations for a pickup in economic growth in Europe around a defense buildup. And China is meeting for its National People's Congress this week. And as expected, they picked up their deficit objective, which means they're perhaps girding up for a little bit more fiscal stimulus. But none of those things have yet to materialize, and none of them are actually doing anything for growth today. Instead, these numbers remain relatively anemic. Meanwhile, the U.S. has tumbled from its perch just at the end of last year, where this was January, this is February, and what we've done is, instead of seeing China and the Eurozone converge on U.S. strength, we have seen the U.S. converge on their weakness. Of course, we've just received the February update for the global PMI numbers, and as a consequence, when we have this kind of a situation where two of the three engines of global demand aren't working, and the third is rapidly coming apart, the whole global pie is following suit. And you can see here the composite index is, at this point, as of February, down to the lowest levels we've seen since early last year, late 2023. So, needless to say, the markets are not off sides to be concerned about a global economic downturn and perhaps recession. Not surprisingly, what this has also done is it's powered a dovish shift in Fed policy expectations. And this really speaks to the other big event risk that the markets face tomorrow. After the jobs data, we are going to get a policy speech from Federal Reserve Chair Jerome Powell. He's going to issue one of these speaking opportunities to assess the economic outlook. This is not going to be obviously a policy announcement speech that'll have to wait for later in the month, but we will get the clearest indication that we've seen in weeks as to what the Fed thinks of all of this. We know where the markets think. They've clearly adjusted in a very dovish way. You can see here the cumulative rate cut tally now versus even just a month ago has been dramatically changed. In fact, now the market's anticipating 93 basis points in rate cuts this year and next. They were at close to 42 or 45 just 3 weeks ago. And so we have a situation here where the markets have clearly extrapolated an economic downturn and extrapolated some sort of growth risk to the tune of at least one, probably more rate cuts than they were expecting even just recently over the forecast window. Moreover, there's a sense of urgency in what the markets are saying. We can see for this year alone, 72 basis points are on the menu. That's only 3 basis points shy of baking in fully 3 rate cuts at 25 basis points apiece. The outlook for next year, again, only 3 basis points shy of 1 cut. That's how we get to 93. Now, the tally total lines up fairly closely with what the Fed itself anticipated back in December. We can see the adjustment here was from an outlook calling for 3.4 as the rate for 2025 in September to 3.9. From 4.4 to 3.9. That's 50 basis points. From 3.9 then into 2026 to 3.4. That's another 50 basis points. So there's 100 basis points in cuts here that the Fed envisioned in December between this year and next, which is very similar to the 93 basis points that the markets now have in their outlook. And so seemingly there is alignment, but the markets are wanting that stimulus to come faster. They want 3 cuts this year, 1 cut next year, not this more leisurely spacing out 50 and 50. Now, this, of course, represents a challenge for Fed Chair Powell. He can't exactly ignore what he is seeing: stock markets falling, growth expectations unraveling, rate cut expectations building. He, of course, has to acknowledge that this is occurring. But what he does next with that information, that will be very interesting indeed. Now, he may decide that now is the time to dial up dovish intent. Say, you know what, if the economy is coming off a cliff, we are going to react. We see the data that's been coming. We note that it's having the effect that it's having, and we are going to stand in front of this train and use our policy muscle to help get things back in the right direction. Of course, that's exactly what markets want to hear. It would also be a dramatic U-turn, considering that for the past several months, the Fed has said nothing, but they are in an incremental adjustment stage. They are very close to getting inflation to be trending on target to 2%. They want to make sure they narrowly do that without hurting the labor market. Their objectives are in balance. Their preference is to wait and see and not to make rash or radical changes, and also not to overinterpret data flow. Now, one might say they are supported in having a little bit of a more dovish perspective, and that Chair Powell might reflect that, considering inflation expectations have started to tick down against the backdrop of all of this consternation in the markets. So as yields have come down and as the dollar has come down with them, we can see that inflation expectations have ticked down as well. This, of course, reflects downturns in economic growth expectations. So the Fed would be on reasonably solid footing to say, well, the markets are envisioning some sort of economic weakness that we are going to push back against. That could give Chair Powell some room to get a little bit more dovish. But at the same time, the ISM PMI surveys that we got this week from the Institute of Supply Management, they tell us that with all of this consternation and uncertainty around tariffs, costs are rising. And so the price indexes for services and for manufacturing, especially where that sensitivity to tariffs is greatest, that is surging. So the Fed is not exactly in a position to say that it can confidently conclude inflation is a objective that's met. It's an afterthought at this point, and we have to go the other way and focus exclusively on growth. Here come rate cuts. That is probably something that would look too erratic and spook the markets more than help them. And besides, the trends in price growth don't seem to support it, which sets the stage for a speech from Chair Powell that perhaps acknowledges what's going on, but keeps an even keel and maintains an incrementalist perspective and says, well, we are, of course, going to react if things get scary, but we're not going to overinterpret this data. For now, as they've been saying, we are going to walk this slowly. We'll see you for the policy announcement later this month. That could be a better venue, perhaps, and some stage setting for that might happen here with a bit of dovishness, but a full-throated and a dramatic pivot, that's probably unlikely. And with that, we end up with a bit of a toxic mix. if jobs data is going to surprise to the downside of these expectations, and Chair Powell is not going to endorse this sort of readjusting with a headlong dive to the dovish side of the policy spectrum, the markets are going to probably reason as follows. The economy is slowing. The risk is rising. The Fed is not going to act with urgency, at least for now. So that probably means stocks have more room to go down. The help is not coming imminently and not in a hurry. So bond yields downwind at the longer end of the curve probably have room to come in further, and bond prices have probably some room to come up. And because the Fed is going to have to then play catch up on easing into an economic downturn, the pace of easing will probably have to be more dramatic later. We saw that same story play out last year when the Fed was frustrated with the Fed's inaction, as we discussed earlier, mid-year, and started to rapidly bake out more easing because they felt the Fed was dragging their heels. That's probably not good news for the U.S. dollar as yield differentials turn increasingly against it. Of course, it doesn't help at all that the policy calculus, let's say for Europe, is changing to a more hawkish perspective as markets eye what the defense build out now envisioned there would mean for inflation and growth. But just from the dollar's side alone, weakness in the economic data, in this case, very important economic data like the jobs report, coupled with a Fed that doesn't seem to be running out the door to do anything about it, that probably means sentiment doesn't get much of a lift, while rate cut expectations get another big bump out along the horizon. That probably helps bonds. It probably hurts dollars. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am back with Chris for Futures Power Hour Mondays and Fridays, so I'll be there tomorrow talking about what this jobs data has wrought. I'm likewise on with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.